Welcome back, everyone. Now we're going to be talking about credits and other taxes. In this lesson, we will discuss the different types of credits, how they affect tax and refunds, and we'll look at other taxes that may appear on the return.
There are two types of credits. Non-refundable credits, which can only reduce the amount of tax to zero, but cannot provide money to taxpayers beyond that point. Non-refundable credits are figured on the 1040 and on Schedule 3. The total amount of non-refundable credits will be listed on line 21, but the amount on line 21 will never exceed the amount on line 16, which is the tax owed by the taxpayer. The non-refundable credit's job is to decrease the tax owed as close to zero as possible. Refundable credits, however, can reduce the tax liability below zero and add additional money to the taxpayer's refund. One of the largest refundable credits is known as the Earned Income Credit and is found on line 27. We will discuss the Earned Income Credit in Part 6 of the presentations. Refundable credits and payments can be found on Schedule 3.
Non-refundable credits include credits for education, credits for children, and credits that encourage retirement savings.
Let's start with credits for kids. The child tax credit is a partially refundable credit worth up to $2,000 per qualifying child. The additional child tax credit can make a portion of up to $1,500 refundable for certain taxpayers with a tax liability too low to take advantage of the full credit. The child must be claimed as your dependent, and here's the kicker: the child must be under age 17 at the end of the tax year. So the year the child turns 17, they no longer qualify for the child tax credit. This is shocking to a lot of taxpayers because they assume the cutoff age is 18. This could mean a full $2,000 reduction in refund for some taxpayers. It is important to share this information with clients when we recognize these situations to help them avoid unwelcome surprises the next tax season. As long as all the dependents' information is entered correctly, the software will automatically calculate the child tax credit and the additional child tax credit. If your dependent doesn't meet the rules for the child tax credit, are you just out of luck? Not quite. There's also the credit for other dependents. Unlike the child tax credit, the credit for other dependents is strictly non-refundable. It can reduce the tax liability by $500 for every dependent claimed on the return that does not qualify for the child tax credit. So just who would that be? Let's remember the eligibility rules for the child tax credit. The child tax credit is available for qualifying children aged 16 or younger at the end of the tax year. So the credit for other dependents will be available for any dependent who does not match that description, including qualifying children aged 17 or older, any qualifying relative dependent, or children who can't be claimed for the child tax credit because they have an individual taxpayer identification number or an ITIN instead of a Social Security number.
Form 2441 is used to claim the credit for child and dependent care, which you may hear referred to as the daycare credit, although that is a bit of a misleading term. The credit is available to taxpayers who, in order to work or look for work, pay someone to take care of their qualifying person. It is a strictly non-refundable credit. The qualifying person can be a child under age 13. If the child turns 13 during the tax year, only the expenses before that date will qualify. As I said earlier, calling it the daycare credit is misleading because the credit can also be used for a spouse or other dependent who is unable to care for themselves. The credit ranges between 20 and 35% of expenses up to $3,000 per qualifying person, with a maximum of 2. What we need from the client is the amount they paid and the employer identification number or social security number and address of the provider. And a final note on the credit for child and dependent care. Make sure you enter every box on the W-2 into the software. If the taxpayer received any employer-provided dependent care benefits, they will appear in box 10. These are pre-tax benefits, and the amount of the taxpayer's credit will be reduced by the pre-tax amount. If the W-2 is entered correctly and Form 2441 is properly filled out, the software will take care of the calculations. Using Form 8863, taxpayers who pay qualified education expenses can claim education credits for themselves, their spouse, and their dependents who were enrolled in an eligible post-secondary educational institution during the tax year. So generally, universities, colleges, or vocational schools. There are 2 credits available to taxpayers: the American Opportunity Credit and the Lifetime Learning Credit. Taxpayers married filing separately cannot claim any education credits. Expenses paid by the taxpayer's dependent, a third party on behalf of the student like a relative, proceeds from a loan, and taxable scholarships and fellowship grants are considered paid by the taxpayer. If the student is a dependent, the taxpayer who claims the student as a dependent is the one who claims any education benefits on their return. If a student is not claimed as a dependent on another person's return, only the student can claim the credit. Qualified education expenses must be reduced by tax-free portions of scholarships and fellowship grants, Pell Grants, tax-free employer-provided educational assistance, veterans educational assistance, and any other non-taxable payments received as educational assistance, not including gifts and inheritances. Form 1098-T is issued to students by educational institutions to help the taxpayer determine their educational tax benefits. Schools are required to report a student's qualified expenses in Box 1, which shows amounts paid to the school. There are often errors with this reporting, so we encourage tax preparers to review account statements with clients to confirm that the reported amount is correct. Some qualified educational expenses like books may not be included in the number reported on the 1098-T. If there are adjustments made for a prior year, they may need to amend or correct their prior year return with the new information. Refer to the Education Benefits tab in your 4012 and ask for assistance if necessary. Some of these can get tricky, however, most 1098-Ts are pretty straightforward. Amounts in Box 5 typically reduce the amounts reported in Box 1. Generally, scholarships and grants are treated as tax-free educational assistance. If the amount in Box 5 is higher than the amount in Box 1, it is likely that the student didn't pay anything out of pocket toward their tuition, so there would be no tax benefit unless they have other qualified education expenses. So to finish up with the 1098-T, if Box 8 is checked, they were at least a half-time student, and if Box 9 is checked, they were a graduate student. All of this information will help you determine if a student is eligible for an education credit and which one. Let's take a closer look at the education credits available to taxpayers: the American Opportunity Credit and the Lifetime Learning Credit. First, the benefits. Since these are credits, they both reduce tax. With the American Opportunity Credit, up to 40% of the credit may be refundable. The Lifetime Learning Credit is not refundable. The annual limit for the American Opportunity Credit is per student, and for the Lifetime Learning Credit, it's per return. Expenses other than tuition and fees that qualify for the American Opportunity Credit are books, supplies, and equipment needed for a course of study. For the lifetime learning credit, amounts paid for books are considered only if they are paid to the institution as a requirement to enroll or attend, like at a vocational school, for example. Education that qualifies for American Opportunity Credit is undergraduate and graduate, with a caveat coming up. The lifetime learning credit includes undergraduate, graduate, and other courses taken to acquire or improve job skills. Other conditions for the American Opportunity Credit. It's only available for 4 tax years. So if a student was an undergraduate during the first part of the tax year and became a graduate student that same year, the student may qualify for the American Opportunity Tax Credit for the entire year. But once a student completes 4 years of post-secondary education, they no longer qualify for the American Opportunity Credit, regardless of whether or not they took the credit for those 4 years. They must also be at least a half-time student with no felony drug conviction. There is no limit on how long the lifetime learning credit can be claimed, hence the name, and no other conditions. To find qualified education expenses, look at Form 1098-T to find the amount of tuition and reduce that by any tax-free scholarship or grant to get the amount used to figure the education credit. If the student is getting the American Opportunity Credit and had additional out-of-pocket expenses for books, you would add those in as well. Tuition combined with the cost of books becomes qualified education expenses. Tax-free payments are adjustments to qualified education expenses, and net tuition becomes adjusted qualified education expenses, which is the amount used to figure the American Opportunity Credit. So let's change things around. Same amount of tuition in books, but an increased amount in box 5. Here's an instance where the amount in box 5 is greater than the amount in box 2, which is common at our tax sites. But the taxpayer still has an adjusted qualified education expense to figure the American Opportunity Credit once you consider their other expenses. So if the amount in box 5 is greater than the tuition amount, they may not have any qualified education expenses for a credit, but make sure to ask clients who are students about all of their school expenses and let them know what is allowed and what isn't. Since the American Opportunity Credit is still a pretty new credit, they may not be aware that the cost of books can be included.
Now that we have covered education credits, let's talk about credits that encourage retirement savings. The Savers Credit is a non-refundable credit for taxpayers who contribute to certain retirement plans like an IRA or employer-sponsored plan. This credit was created to encourage taxpayers to save for retirement. To be eligible, you have to be 18 or older, not a full-time student, and you cannot be a dependent. The credit is worth between 10 to 50% of up to $2,000 of contributions, depending on your income. One interesting thing about this credit is that taxpayers can get a double benefit. What this means is that the taxpayer can get a tax deduction and a tax credit on the same money. Let's take a quick look at a W-2 of an employee that contributed to their retirement plan. Boxes 3 and 5 show the total wages earned. Box 1 of the W-2 is the total wages reduced by the amount contributed to a retirement plan. The Box 1 amount is what gets carried to the 1040. So those retirement contributions are not included in taxable income. But if the taxpayer is eligible for the Savers Credit, they can then get a credit based on the same contribution, even though they are already not being taxed on this income. In addition, with the Savers Credit, taxpayers have the power to change the outcome of their return after the tax year is over. Taxpayers have up until the due date of the return, usually April 15th, to contribute to retirement accounts like IRAs and have that contribution count toward their prior tax year. The Savers Credit is a tax tool we can use to help our clients save. That's all for credits. Let's talk about other taxes. These are not the usual income taxes, but other special taxes that can be added to the return in certain circumstances. Other taxes include self-employment tax. This is Medicare and Social Security payments that taxpayers who are self-employed or independent contractors must pay. Additional tax on retirement accounts. We discussed this in the income section. If a taxpayer receives a distribution from their retirement account before age 59 and a half and do not qualify for an exception, they will pay income tax on the distribution and a 10% penalty. First-time home buyer credit repayment. This is for taxpayers who purchased homes in 2008 and got a credit that must be paid back. These are rare. These amounts are totaled up and added to the base tax figured from a taxpayer's total income.
Payments and refundable credits. Once the total tax is figured, it's time to apply payments. Federal income tax withheld from W-2s and other forms is a payment. Earned income credit and additional child tax credit are payments also. If the client had no tax liability or a very small one, the additional child tax credit allows them to get more of the child tax credit by making it refundable here. The refundable portion of the American Opportunity Credit will appear here as well. And the last we'll cover, you've got the net premium tax credit. The premium tax credit is a new federal tax credit, which is part of the Affordable Care Act, designed to help eligible taxpayers pay for health coverage. Any taxpayer receiving the premium tax credit needs to be served by an advanced level preparer, so come back next year to learn more. All payments are added together and compared with the tax liability to yield a refund or an amount owed to the government.
Well, that's a wrap on credits, except for one more, which we're going to dedicate an entire section to, and that's the earned income credit. So let's get to it.